Should you sell your house to your kids for $1? This is the family transfer they really don't want you doing. If you're over 50, you own a home, and you've ever thought, maybe I'll just sell the house to the kids for $1 so they don't have to deal with taxes or probate, this video is for you. On paper, that $1 price tag looks like a loving, clever gesture. You're thinking, I'll make it easy for them. I'll outsmart the system. But in reality, that move can trigger thousands, even hundreds of thousands of dollars in surprise taxes and problems for your children. I have seen families do this, thinking they were doing the smart, loving thing, only to watch the kids get crushed years later by capital gains tax, nursing home penalties, property tax jumps, and even bitter fights between siblings that mom and dad never imagined. What started as, let's just make it simple, turned into, how did this go so wrong? In this episode of George Edward Explains, we're going to walk through what really happens when you sell a house for $1, the hidden tax traps almost nobody tells you about, safer ways to pass your home down, and a simple checklist to go through before you sign anything. If you could avoid making one mistake that could cost your kids more than your entire first mortgage, would you give me the next 25 minutes? Stay with me, because the part near the middle, about capital gains and something called step-up in basis, is the part that shocks most parents when they finally hear it in plain English. Welcome to George Edward Explains. I'm George, and here we talk calmly and clearly about money decisions that really affect your retirement and your family. Today we're talking about that very common idea. I'll just sell the house to my kids for $1. That will make everything easy. We're going to slow that idea down and look at what really happens behind the scenes when you do that. Before we go any further, I need to say this clearly. This is education, not personal legal or tax advice. I am not your attorney and I'm not your CPA. Before you move a house, sign a deed, or change ownership, please talk with a qualified estate planning attorney or tax professional who understands your full situation and your state's laws. All right, let's start with why so many good parents even think about the $1 transfer in the first place. If you're like a lot of folks I talk to, your heart is in the right place. You've worked all your life, you've made a home, and you want that home to be a blessing, not a burden for your kids and grandkids. So you start thinking, I don't want the courts involved. I don't want this tied up in probate. I don't want the government taking a chunk. I'll just get it into the kids' names now. Maybe I'll sell it to them for $1. That'll show it's theirs and keep things simple. Sometimes the idea comes from a neighbor. Oh, we sold our place to our son for $1. No tax, no fuss. Sometimes from something you see online, a quick video or a post saying, avoid probate, just put the kids on the deed or sell the house to them for $1. It sounds easy. It sounds like a shortcut around lawyers and paperwork. Here are the most common reasons I hear from parents and grandparents. I want to avoid probate. I don't want my kids dealing with courts. I want to save on taxes, but I don't really know how it all works. I just heard this is a way. I'm worried about nursing homes or creditors taking the house. If it's in the kids' names, they can't touch it, right? I just want to be fair and get things done now while I'm still here so the kids don't have to worry. Maybe you've even thought, I'll just put their names on the deed and that will solve everything. Have you ever caught yourself thinking something like that? Did anyone ever actually sit you down and explain how the IRS looks at a $1 sale? Let me say this very clearly. The problem is not your heart. Your heart is in the right place. You're trying to bless your children. The problem is that the tax law does not see this as a kind little favor. It sees it as something else entirely, and that something else can be expensive. To understand the danger, we first need to talk about how the law sees a $1 house transfer. And I promise, I'll keep this in plain English. Imagine your house is worth $300,000 on the open market. You decide, I'll sell it to my daughter for $1. From your point of view, that's a sale. You sign a deed, it says $1. You might even write that on the document. From the IRS's point of view, and from most state perspectives, they don't really believe you sold a $300,000 house for $1. They treat that as mostly a gift, a tiny part sale, the $1 and a huge part gift, the $299, the $999 worth of value you effectively gave away. There's a whole area of law called gift tax. Don't let that phrase scare you, but don't ignore it either. In the U.S., when you give someone property for less than it's really worth, that difference is considered a gift. There are rules about how much you can give each year without paperwork, and there's a lifetime amount you can give above that before estate and gift taxes might kick in. I won't bury you in numbers because they change and depend on your situation. What matters for you is this. Even if you never end up writing a check to the IRS for gift tax because current lifetime limits are high, a $1 transfer of a big house is not invisible. In many cases, it should be reported, and it uses up part of your lifetime gift and estate tax allowance. It's not off the radar just because you wrote $1 on the deed. But the gift tax paperwork is not even the biggest problem. The bigger trap is something called basis. Think of basis as your starting number for figuring gain when a property is sold. If you bought your house for $100,000 years ago and you didn't do anything fancy, your basis is around $100,000, maybe plus some adjustments for big improvements. If that house is worth $400,000 today and someone sells it for $400,000, the gain, the profit in the taxman's eyes, is the sale price minus the basis. Here's the important part. When you give someone a house while you're alive as a gift, the basis usually goes with it. Your child doesn't start fresh at the house's current value. They inherit your old basis. Picture this in your mind. You bought the house for $100,000. Today it's worth $400,000. You decide to sell it to your son for $1. From the tax point of view, you just made a huge gift, and your son's basis in that house is now about $100,000, that old number. Years later, he sells the house for, say, $450,000. The IRS looks at that and says, okay, $450,000 sale minus $100,000 basis equals a $350,000 gain. That $350,000 is what can be exposed to capital gains tax. Most parents who do the $1 transfer think they are removing tax from the situation. In reality, they are often moving the future tax from themselves onto their children, and in a way that can make the number much bigger. And we haven't even gotten to the big hidden benefit you can lose by giving the house away while you're alive. That benefit is called a step-up in basis. This is the part that makes a lot of people sit back in their chair and say, why didn't anyone tell me that sooner? Under current U.S. rules, in many cases, when you die still owning a house and your kids inherit it through your estate or trust, the tax law does something kind to them. It steps up the basis to the market value on the date of your death. That means your kid's starting number, for tax purposes, becomes what the house was worth when you died, not what you paid decades ago. Let's go back to that simple example. You bought the house for $100,000. By the time you pass away, it's worth $400,000. If your kids inherit that house at your death, through a will, a trust, or another proper mechanism, their basis may step up to $400,000. Now imagine they sell the house 6 months later for $410,000. In the taxman's eyes, their gain is only about $10,000, not the $300,000 plus gain you saw over your lifetime. In some cases, depending on timing and exemptions, there may be very little tax at all when they sell. All that growth that happened during your lifetime, from $100,000 to $400,000, can essentially be washed away for capital gains purposes when they inherit. Now contrast that with the $1 transfer while you are alive. If you give them the house now for $1, they don't get that step up. They usually get your old low basis, around $100,000 in our story. When they sell, every dollar between their sale price and that low basis is potentially taxable gain. Scenario A, you keep the house in your name, you live there until you pass, and your kids inherit it properly. House is worth $400,000 when you die. They sell soon for about $400,000. Very little, maybe almost no capital gains tax. Scenario B, today, at age 72, you sell the house to your kids for $1. 10 years later, they decide to sell, and the house is now worth $500,000. Their basis is still around $100,000. Now the potential gain is $400,000. That's the number the IRS looks at. Even at moderate tax rates, the bill on that can be big. On top of that, there can be other side effects of a lifetime $1 transfer. In some states, a change in ownership can trigger a full property tax reassessment. Your old assessment might have been low because you've lived there for years. When you transfer it, the assessor may reset it to full current market value. That can send the annual tax bill through the roof for your kids. If you still have a mortgage on the house, your loan might have a due on sale clause. That means the lender can demand the full balance be paid when the property is transferred. A $1 deed to your kids could theoretically trigger that clause. Sometimes banks look the other way if payments continue, but counting on their kindness is not a plan. If you ever need Medicaid or other long-term care assistance, there is something called a look-back period. Transfers of your house for less than its true value, like giving it to your kids within a certain number of years before applying, can be treated as gifts meant to avoid paying for your care. That can create penalties or delays in getting help. Again, details vary by state, but it's a real issue. So ask yourself honestly, would you really want your children to get a massive tax bill years from now, or a nasty surprise from the assessor or the nursing home office, all because you tried to make things simple with a $1 deed today? Did anyone ever tell you that by keeping the house in your name until death, you might actually be reducing the tax your kids pay, not increasing it? If the $1 sale is usually a bad idea, what are the better ways to get this house where you want it to go? Let's talk about alternatives. I won't go into deep legal detail because this absolutely is where you need a local attorney, but I want you to know the kinds of tools that exist. So when you sit down with a professional, you're not starting from zero. One option is the simplest. Let them inherit through your will or trust. You keep ownership while you're alive. You live in your home, you control it. When you pass away, your will or your trust says, "This house goes to my children." Under current law, that often allows for that step up in basis we talked about. It also means you don't lose control of your home while you're still using it. Another option is a revocable living trust. In plain English, that's a legal bucket you create during your lifetime. You put the house into the trust, but you are still in charge of it as the trustee. You can sell, refinance, move, whatever you want, while you're alive. When you die, the trust says who gets the house. In many states, this can help the house pass more smoothly, often avoiding full probate, and still allow for tax benefits similar to inheritance. Some states have something called a transfer on death deed or beneficiary deed. Picture a deed that says, "This is my house while I'm alive. When I die, it automatically goes to my kids." You don't actually give it to them now. You keep all the rights while you're here, but you've pre-written the transfer for after your death. These can be a simpler tool in some places, though they still need to be done correctly and may not be available everywhere. There are also life estate arrangements where you keep the right to live in the house for the rest of your life, but some ownership interest shifts to your children. These can have certain uses, especially in Medicaid planning, but they are complex. They can also cause tension because technically the kids own part of the house while you're alive. You do not want to do a life estate deed off a form you found online without a lawyer guiding you. In some cases, a properly structured sale at a real fair price can be used. For example, you might sell the house to your child for a genuine market value, and you become the bank. They pay you back with a private mortgage over time. Done correctly, that can help transfer equity and give you income. But again, this is not something to make up over coffee. It needs professional design. I've seen families do this the calm, careful way. One couple I knew had their home in a living trust. When they both passed, their children received the house through the trust language. The kids sold it not long after. Because of the step-up in basis rules, the tax on the gain was minimal. There were no surprises, no sibling fights over "mom gave you a secret deal," and no shock bills years down the road. Contrast that with a family I heard about through a friend. The parents deeded the house to one son for $1, thinking it was understood he'd share with his siblings later. When the parents died, the son considered the house legally his. The others felt cheated. Lawyers got involved. Relationships broke. The parents thought they were being clever and loving. They left a mess. So which sounds safer to you? A quick $1 form you found online, or a plan you and your kids actually understand and agree on, written up by someone who does this for a living? Have you ever actually sat down with your children and had a calm conversation about what you'd like to happen with the house? You don't have to show them all your bank accounts, but talking about the home can save a lot of guesswork later. Now, are there times when some kind of discounted transfer or complex plan might make sense? Yes, but they are far narrower than most people think. There are complicated strategies some estate planning and tax attorneys use in special situations. Family businesses, special needs planning, large estates exposed to estate tax. Those might involve transferring partial interests or using special trusts, and on paper you might see low numbers used in those documents. But those are not simple, sell it for $1 and hope for the best plans. They are detailed, customized, and built around your full financial and family picture. Here's the key. If the idea to sell your house to the kids for $1 came from your own attorney after a thorough review, that's one thing. If it came from a neighbor, a Facebook post, or a quick YouTube short, not from someone who actually knows your situation, that's a giant red flag. Look for these warning signs. You're being pressured to move fast. Sign this now before the law changes, or we need to do this week. The person pushing it stands to gain. One child who wants the house, or someone who wants to buy it cheap. No one has mentioned basis, capital gains, Medicaid look-back rules, property tax reassessment, or your mortgage terms. It's presented as a simple deed change with no downsides. A $1 sale to one child can also feel like a betrayal to the others, even if you meant well. Why did mom transfer the house to you and not us? I've seen families broken not by the size of the inheritance, but by the feeling that one person got a secret deal. Would you rather save a little money on legal fees now and risk your kids fighting later, or spend a little time and money on a proper plan that everyone understands? Sometimes the real gift you give your children is not the house itself. It's the lack of confusion and resentment. So what should you actually do if this idea has already crossed your mind or someone in your life is pushing for it? First, don't sign anything yet. If you've been thinking about a $1 transfer or putting the kids on the deed just in case, hit pause. Don't sign a deed or change the title before you understand the consequences. Once the house is out of your name, getting it back can be hard, messy, or impossible without more taxes and legal costs. Second, get the big picture on one page. Sit down at your kitchen table and write out a few simple things. Roughly what your house is worth today. You don't need an exact appraisal. A ballpark from recent sales or online estimates is fine for now. What you originally paid for it, or about what you put into it over the years in major improvements, whether you still owe anything on a mortgage or line of credit, who you want to receive the house when you're gone. All kids equally. One child, someone else. This one sheet of paper will help any attorney or tax pro give you much better guidance. Third, schedule a short meeting with a professional. Look for a local estate planning attorney or elder law attorney, someone who deals with wills, trusts, and property transfers all the time. Call their office and say something simple like, "I'm thinking about what to do with my house for my kids. I've heard about selling it to them for $1. Can I schedule a short meeting to understand what really happens tax-wise if I do that versus letting them inherit?" When you sit down with them, ask very directly, what happens tax-wise if I sell this house to my kids for $1? What happens if I let them inherit instead? How would this affect any Medicaid or long-term care planning? Does my state do anything funny with property tax when ownership changes? Don't leave until you've heard those answers in words you can repeat to someone else. Fourth, talk to your kids calmly. You don't have to involve them in every detail, but it can be wise to say, "We've been thinking about what to do with the house. We learned that some of the quick tricks out there, like $1 sales, can actually hurt you more than help you. We're going to work with an attorney to put a plan in place that's fair and smart." Ask them, what would you want us to do that feels right and avoids trouble later? You might be surprised at how reasonable your children can be when they feel included instead of blindsided. So let's recap in plain English. Selling your house to your kids for $1 usually looks like love, but the law often treats it like a taxable gift. You don't magically erase taxes. You often just move them around, and you might make them bigger. When you give the house away during your lifetime, your children often inherit your old, low basis. That means when they eventually sell, they can owe capital gains tax on decades of growth. If instead they inherit the house at your death under current rules, they may get a step up in basis to the value at that time, potentially saving them a very big tax bill. A quick $1 deed can also cause other problems: property tax reassessment, mortgage issues, Medicaid penalties, and family hurt feelings. There are better tools: wills, revocable trusts, transfer on death deeds in some states, life estate plans, properly structured sales that can move your house where you want it to go in a way that protects both your home and your family relationships. But they need to be designed with professional help, not copied from a neighbor. You have worked too hard for too many years to have one rushed decision create problems for the people you love most. You don't have to become a tax expert. You just have to ask better questions and avoid shortcuts that sound too simple. If this helped you, share it with a friend or relative who's talked about just putting the kids on the deed or selling for $1. And if you want more clear, calm explanations like this, follow along here on George Edward Explains. Hit subscribe, tap the notification bell, and let's keep walking through these decisions together. I'm George. Thanks for spending this time with me. Now, before you sign anything about your house, take a breath, get your facts on one page, and give a good professional a call. Your kids and your future self will thank you.